Good afternoon and thanks for joining. I'm Tom Harvey with J. Edward Sellers, and today's session is going to be about retirement planning. So 5 ways to make your retirement income last and avoid running out of money. This is actually a recording of a session I took earlier this week. We had some technical difficulties, so for anyone that attended, apologies and thank you for your patience. Hopefully you can get some value out of the session today anyway. So just before we get going, a little bit of housekeeping. Usually we'd have a Q&A box at the bottom, but being a recording, that's obviously not available today. But if you do have any questions, please feel free to scan the QR code or call us on the number below. It should last about 40 minutes this afternoon. And bear in mind, none of the information in today's presentation should be regarded as advice or a personal recommendation. If you need that, feel free to contact us via either one of the methods on screen now. So our agenda. First, we're going to look at the challenge that is saving for retirement. Then we're going to move on to optimizing guaranteed sources of income, then maximizing the freebies. Also, we're going to need to think about taking the right amount of risk, both on the run up to retirement and during. And we're also going to have a talk about selecting the appropriate withdrawal method and amount. So to begin with, understanding the challenge. So first we need to kind of set out our objectives really. So how much are you looking to spend in retirement? Are there any bucket list items which you'd like to tick off? And is leaving a legacy important to you? To answer some of those questions, we go through a bit of an expenditure analysis. So what is our essential expenditures? What's our discretionary expenditures? Do we require any lump sums? Then we need to make adjustments to that figure to either increase or decrease depending on, say, a mortgage being paid off or children leaving the nest. We also need to apply inflation because that's one of the biggest things that we need to protect your assets against, especially when you think we may be using your assets to fund retirement, which could last anywhere between 20, 30, potentially longer. So we also look at assets and liabilities. So do we have any assets which could produce an income? Do we have any assets which could be sold to produce a capital sum? And also what other financial assets are available? So what existing savings, and could they be better allocated? Do your pensions have all of the withdrawal options available? And how will your family benefit from the pension once you've passed away? So those are the kind of initial checks that we need to make. Expenditure analyses can always be difficult. Obviously, going through a number of transactions, categorizing them, and then figuring out where your money's going at the moment can be arduous work. There are various tools out there now as a result of open banking, apps such as Snoop, where you can punch in a few details and then it will collate your spending for you. So it'll give you a bit of a better idea. When we do it, we usually ask a client to fill out a form which breaks down expenditures, and then we work from that. So we also have to use some assumptions when forecasting. So longevity, how long are you going to survive for? Are you going to fall ill within that time frame and require more money for care, for example's sake? What will investment returns be, and what will rates of inflation be? So all of those inputs kind of go into a pot, and we think, well, what does a client need, or what, if you're doing this yourself, what do I need? Is that enough to get me there? So what I thought we'd do is have a little look over some examples. So there's quite an interesting study that comes out once a year called the Retirement Living Standards. It's put together by Loughborough University, and they basically say for one person, the minimum amount that they'll need to survive is about £13,000 a year, which is pretty much the state pension. For a moderately comfortable lifestyle, you would need about 32,000 a year as a single person, and then to be comfortable, about 44,000. So bearing in mind, this is your expenditure amount, not the income that you're receiving. So we need to aim a little bit higher because tax is going to be taken off of the income that you receive. This is the amount that you spend. So for two people, 22,000 as a minimum. Obviously, there are some cost savings with sharing certain items as two people, and then you can see the figures going up from there. Okay, so in the example today, we're going to base it on a single person living a moderately comfortable lifestyle. And this person's objectives and their situation now. So they like to retire at 68. They expect to live until 82. State pension, nearest damn is going to be £12,000 per annum. And we already know we're going to be spending £32,000 per annum. So there's going to be a shortfall of about £20,000 a year. So with those inputs, what do we need as an asset to fund that gap? So worked out with a few different options here. So we've got cash in the bank. To see you through that period of time, you'll need about 316,000 set aside in the bank. To get a level annuity, which is an annuity that doesn't increase with inflation, again, it would be about 316,000. An annuity escalating at 3% a year would cost around 373,000 to produce that £20,000 a year income. So that's based on a person being around 65, between 65 and 68. And those assumptions were from, well, that annuity rate was from earlier this week. So it's pretty current, depending when you're watching this. We'll go into some more details about annuities later, but yeah, that kind of shapes the challenge and gives you an idea of how much money you need just to get to that comfortable level, or that moderately comfortable level, I'd say. Also, retiring at 68, some people might want to retire a bit before 68. So again, that would mean more money that we need to save up front. So just to give you an idea of how much would need to be saved for the various different options, and I haven't applied any investment growth with this. Again, investment growth and risk is something we'll come on to, but that makes up an important part of getting to that objective or meeting that challenge, really. So for somebody at 30, cash in the bank, you'd need to save £693 per month. To buy the annuity, about 554, and the escalating annuity about 654. So the annuity options are lower than the cash option due to the tax relief that you get from within a pension. So 20% gets added back on straight away, with further reclaims available through self-assessment as well. So kind of highlights the benefit of saving for retirement through a pension already, really. I won't read out all of those other figures. If you need to pause the video just to have a look through, please do. But moving on to the next section. So optimizing guaranteed sources of income. So what guaranteed sources of income are available? So we've got the state pension, final salary pensions, otherwise known as defined benefits. Annuities are a guaranteed source of income. And once you're in retirement, attendance allowance and pension credit may also be available. So if we start from the top then, the state pension is a government-paid inflation-linked income that you receive for life once you reach state pension age. You need to have a minimum of 10 years qualifying national insurance contributions. To get the full state pension, that needs to be 35 years. It's currently just under £12,000 and it's paid for weekly in arrears. So yeah, that's why I've used that £12,000 figure earlier, because it's near as damn it there. It counts as income, so we'll use your personal allowance for income tax. And what a lot of pensioners are finding at the moment, because their pension's been in payment for quite some time, it's gone up in line with inflation, but the tax allowances haven't done. People are starting to pay tax on their state pension as well. Difficulty being that has to be done through a tax return or is either taken off of other pensions, because it's always paid gross. So how does the inflation protection work? So the state pension is subject to the triple lock. This means it will increase by the highest of inflation, average earnings growth, or 2.5%. So you've probably heard about the triple lock. It's in the media quite a lot because it's quite expensive for the government to keep going. successive governments have kept it in place, there is a big question mark as to whether it continues to be affordable. Just as a quick aside, obviously we've got a budget coming up in November. There's a lot spinning around the rumour mill at the moment as to what's going to happen. When we create financial plans, when we advise clients, we can only advise on the facts right now. We can't account for speculation because we may go one way because of that speculation and something different happens. And it's something that we really try and impress on our clients, is that let's not worry too much about the speculation. When the news comes out, we'll adjust things from there, which is why an ongoing service can be quite attractive, really. Okay, so optimizing the state pension. So your state pension, as we've said, is based on a number of qualifying years on your national insurance record. You need 10 years at a minimum to get some, 35 years to get the full state pension. There may be gaps in your record through career breaks, low earning, time abroad, all of which may reduce your state pension. So you can sometimes buy back missing years with voluntary NI contributions. The costs are generally low, about £800 to £900, and each year can add up to £300 to £330 of state pension, which gets paid for the rest of your life. So that doesn't take very long for that £800 and £900 expense to be paid off. Basically makes it one of the best value annuities available, although it is always case dependent. So how do we go back and check? So first check we need to make is you might already have credits for those missing years, maybe for childcare, caring for a relative, or on other benefits. Some years can't be topped up, so you might be too old or already qualifying. And it's important not to overpay, because even if you were to make a voluntary national insurance contribution and you've got your 35 years, you don't get any additional state pension on the back of that. Normally you can buy up to 6 years back, but temporary windows will sometimes allow more. So always worth first checking your national insurance record. For those coming up to retirement, always check the state pension forecast tool, and you can contact the Future Pension Centre before making any payments, and they'll confirm if topping up will actually benefit you. Then if advised by the Future Pension Centre, pay HMRC Class 3 national insurance contributions to make that top up to get a greater state pension. So final salary or defined benefit pensions, sometimes abbreviated to DB. These are usually, well, these are always set up through an employer. You contribute throughout your working life, and it's usually formula driven in the sense that 1/60th or 1/80th of each year's service is paid of your final salary. So they often include inflation linking, so payments in retirement rise each year. They also usually include a spouse's pension as well. So on your death, it may be that 2/3 of the pension is paid to either your husband or your wife. They're very secure from the employee's point of view. So in comparison to a defined contribution pension or a personal pension, you're not exposed to any of the investment risk at all. The scheme and the employer carry all investment risk and longevity risk, not you. So it's basically an unknown liability for the scheme and the employer, because they don't know how long that you're going to survive for. Many are now closed because of that. So they've become very expensive to run, but they're still common in the public sector. Some, or most really, allow you to take part as a lump sum, usually tax-free. For doing that, you give up some of that income. So where we can optimize it in one sense is making sure that you take the right amount of lump sum and the right amount of income that's going to see you through, because a lump sum can disappear very quickly, whereas that regular income is going to keep on coming in no matter what. So there was a period of time where people were transferring defined benefit pensions into defined contribution pensions, and they were attracting quite lofty transfer valuations. That was a reflection of the cost of buying and a similar annuity on the open market. And it's kind of a reflection of the value that you're giving up by being a part of that defined benefit pension. 99 times out of 100, it's not the right thing to do, and something that we don't advise on because of that. So they're usually capped at 40 years service, maxing out around 2/3 of the final salary, which again is quite attractive because in retirement you're not going to have some of those expenses like mortgage costs, raising a family, so on and so forth. Some schemes have been watered down a little where they're now career average schemes, so they average out your salary over your career, and it usually works out as slightly less attractive for the employee's point of view. So how else can we optimize it? Obviously, the first optimization is making sure you get the split between pension income and lump sum right. During your working years, you may be able to pay extra contributions to your pension and build up extra years service or extra pension in care schemes. These added years are then treated as normal service when the pension is calculated. So an example of this, so if we had a scheme accruing at 1/60th per year of service, your salary is £60,000, normal service of 30 years, that would basically give you a pension of 50% of your final salary or £30,000 a year, so quite attractive. If you bought 5 extra years, that would turn into a pension of 35,000. So that's an extra £5,000 of guaranteed inflation-linked income for life. So quite attractive. The cost of this then, so added years are usually quite expensive. The thing being, because the scheme's taking on all of that risk, investment, inflation, longevity, they're not going to offer that to you very cheaply because it's quite a risk for them really. Contributions also depend on the age of purchase, so they're cheaper if you do it younger. When you're younger, your priorities might not be retirement, but hopefully this presentation makes you think slightly otherwise, and that starting early is a good thing for your elder self. So they're often paid via an extra percentage of salary until retirement, or sometimes as a one-off lump sum, obviously scheme dependent. Also scheme dependent is how many added years you can buy. So it usually can't exceed a maximum of 40 years. And not all schemes will offer this, to be honest. Why it's worth considering, so it provides certain inflation protected income, very hard to match in today's market. And as we saw with the escalating annuity option earlier, very expensive. Can be attractive as long as if you're a long-term scheme member in good health and expect to live a long retirement. Obviously, that's one of those assumptions that we use. You might think about longevity of your wider family. If they lived a long retirement, you might do as well. Often better value than trying to buy an equivalent annuity yourself. So that's some of the reasons we might want to consider it. Risks and caveats. As with everything, there are risks and caveats to be aware of. So high upfront costs, you're locking in that money so you can't get at it once you've done it. If you leave the scheme early, rules may reduce the value of your added years. So kind of can act like a set of golden handcuffs and keeping you attached to that employer. Death benefits also usually follow scheme rules. So spouse's pension based is on the added years too, which could be a bonus depending on how you look at it. Okay, so coming on to annuities next. So annuities can seem quite straightforward. You use a lump sum of money, buy an income that either pays forever or for a fixed term. Annuities can seem straightforward, but there are a lot of different options, and it's definitely worth shopping around for annuities as well. So once you're done with an annuity, that's it. You can't change it. And there can be some quite big pitfalls if you don't do it right the first time. So we've got a few different options that I put here. This isn't an exhaustive list, but we'll go through them in turns. So you might have the option around a guarantee period. So that may be for 5 or 10 years. Very important that these are considered, because with annuities, if you take out an annuity and it doesn't have a guarantee period, you pass away 6 months later, all of the money that's gone in to buy that annuity is then gone. There's nothing left for your family. With, say, a 10-year guarantee period, if you buy an annuity with that, you die 5 years later, the annuity will continue to pay for the further 5 years or finish off that guarantee period. So at least there's something left for your spouse or your wider family. We've touched on escalation already, so that's when it goes up in line with inflation. Very similar to a guarantee period to protect the family is a joint life annuity. So this may pay out 2/3 on death to a spouse or a dependent. Open market options is when you shop around for a good annuity rate. So say if you're with company X, they offer you an annuity rate of 5%. You can approach other companies and company Y might offer you 6%. And on the sums of money involved, that 1% difference can make a huge difference to life. A level annuity, so usually the cheapest option. That's because the amount is fixed. The annuity provider doesn't have to worry about inflation. Doesn't always make sense for you to take it out though because it's cheaper, because inflation will still be going on in the background. You'll be relying on this annuity for potentially 20, 30 years. And the spending power of that annuity in 30 years' time is going to be a lot lower. You're not going to be able to buy the same amount of goods with that. Next is a fixed term annuity. So this is where you use a lump sum, buy the annuity, it pays out for a predetermined period, say 10 years, and at the end there may be a maturity value. So might be worthwhile if you've got fixed expenses for a period of time, and then you want to keep your options open come the end of that period. Slightly newer addition to annuities is a pension wrapped annuity. So usually what happens with an annuity, you use your pension, you buy the annuity with your pension finishes, so that is no longer, you've got your annuity, it pays you an income, and that income is taxed. With a pension wrapped annuity, your pension is used to buy the annuity, but then the annuity sits within your pension. So what that means, any income goes back into the pension. You can then take it out as and when you need it. So you don't pay tax on it then and there when the annuity pays. It's when you then withdraw the money from the pension. So can be advantageous if say annuity rates are a bit higher and you want to lock in a good rate. If again you want to be a bit more flexible with your income, so take it as and when you need it, but would like the security of an annuity in the background as well. Again, another reason to consider. Enhanced annuities are if you have any sort of medical conditions which may be life limiting. The annuity provider is basically trying to judge how long that you'll live for, offer you an income, and try to profit on the lump sum which they're taking from you. So with an enhanced annuity, they don't think you're going to live as long, being frank, and they'll pay you a bit more because of that. Then we've got an investment-linked annuity, which is basically an annuity which is dependent on investment returns. So more of a flexible, slightly riskier way of taking an annuity. Okay, so coming on to other guaranteed sources of income. So attendance allowance is one which may be of benefit for people above state pension age who may need help with personal care due to illness or disability. So it helps with extra costs of care, not day-to-day living. It's not means tested, so your income and your savings don't affect eligibility. You have to be above state pension age and you need to show you require help or supervision with activities like washing, dressing, staying safe. It doesn't require a carer to be in place. It's about the need itself. With this one, there's two rates, the lower and higher rate, depending on the level of the care need. Both daytime, both day and night. That really depends between whether you get the lower or higher amount. It's paid every week, every 4 weeks, tax-free, and it's received on top of the state pension. So it can increase entitlement to other benefits, such as pension credit, housing benefit, council tax reduction, and it can allow carers to claim carers allowance as well. So why does this matter in planning? So pretty obvious, really. Provides extra guaranteed cash flow in later life. Can make the difference between sustaining independence at home versus needing support. This one is often underclaimed. Many people are eligible and don't even realise they can apply. So If any of those points that I've mentioned on the previous slide ring true for either you or maybe an elderly family member, worth checking. And another guaranteed source of income, pension credit. So this is usually for people on the lower income end of the spectrum. It's an income related benefit for people, again, over state pension age, and it tops up your weekly income if it's below a certain minimum. It's paid just like the state pension by the Department of Work and Pensions. It comes in two parts, so the guaranteed credit and savings credit, and it tops up at income to a minimum guaranteed level. Higher levels if you have a disability or a carer or responsible for a child are also available. So the key feature of this one, it's means tested based on income and in some cases savings and capital. Paid weekly or fortnightly direct to the bank account. And even a small entitlement can unlock other valuable benefits. So opens access to help with council tax, free NHS dental treatment and glasses, cold weather payments, and free TV licenses. Again, like with attendance allowance, one of those that many people don't claim even though they're eligible. So yeah, have a look at that one. So the key features, it's means tested. So if you earn over a certain amount through pensions or you've got a certain amount in the bank, you're not going to qualify for it. Like I said, paid weekly or fortnightly direct into the bank account. So for those people with a lower income, certainly helps with cash flow. And yeah, opens up a number of benefits which could be useful. Okay, maximising the freebies. So you're probably thinking there's nothing for free in life, although with pensions, I would disagree. So the freebies here, we've got auto enrolment, employer national insurance, and a reclaim rather than a freebie is avoiding the 60% tax trap. Okay, so auto enrolment, you've probably heard about this through your employer if you're of working age. So since 2012, employers must automatically enrol eligible workers into a workplace pension scheme. So you, your employer, the government all pay into the pension. So contribution levels at the moment, 5% of employee, including tax relief, 3% for employer. So 8% of your qualifying earnings, which is about 7,000 up to about 50,000, can get paid into a pension for you. Some employers are more generous and match higher contributions, so it'll be worth having a chat with your employer to see if you put in a bit more, will they also follow that in as well. So Aon did a survey in 2024, so last year, and they reported that an average default of 6% employer, 4% employee was going into a pension, which again is more than the minimums, which is good to see. So a sizable slice of employers do go above the minimum, and sometimes it's just about asking that question. So the future value of these contributions with 5% growth, sort of that difference there, can work out to about 165,000, which goes some way to the target that I've mentioned earlier, that 300,000 plus target. Okay, so employer national insurance, you're probably aware that when your employer pays you, based on the level of salary that you're paid, they have to pay national insurance. So with national insurance, if you make a pension contribution, your employer makes a saving on that national insurance because they're not paying it to you. It's going into a pension. They don't have to pay the national insurance, so it's a cost benefit for them. So instead of retaining that saving, they can actually pass it on to you and pay it into your pension. So nice little freebie there that if your employer will allow it, will also give a boost to your pension. So the benefits to the employer, it's cost neutral. It doesn't cost them anything to do so. Can give them a competitive edge in recruitment and retention of staff. And it's a nice tax efficient reward to be able to give to employees. Quite easy for them to administer as well. So it basically ends up for every £100 sacrificed into your pension, you get an extra £13.80 per annum if they give this up. So it's might seem like a small amount, but that's on £100 sacrifice, and it's actually quite powerful over a longer period of time. Benefits for the employees, I don't think I really need to spend much time talking about that, but you get a greater pension contribution. And it boosts long-term outcomes. Even a modest uplift compounds significantly over decades. Okay. So in the example here, we've got employee sacrifices £100 of gross pay, employer NI saving £13.80, reinvested total pension contribution is £113.80, and over 30 years, that £13.80 becomes 11,500 when we apply a growth rate of 5%. Obviously, that growth rate isn't guaranteed, but again, chipping away at that £370,000 target or challenge that we outlined earlier in the presentation. So the 60% tax trap, this is one of those quirks of the UK tax system. And again, this isn't a freebie, but it's more of a reclaim and avoiding quite a nasty tax outcome. So the personal allowance, which is 12,570, is reduced by £1 for every £2 above £100,000. So one for higher earners, but it's quite a good one to take advantage of. This creates an effective tax rate of 60% with income between 100,000 and 125,000. That's the 40% income tax on that amount and the 20% that you're losing on the personal allowance down the other end of your income scale. Many people don't realise that this happens until they start to earn over £100,000, so it comes as a bit of a nasty surprise. Using pensions, though, can allow you to start reclaiming some of that personal allowance. So personal pension contributions extend basic and high rate tax bands. Contributing enough can bring adjusted income back below £100,000 to reserve the full personal allowance. And it can basically deliver tax relief of about 60% on the contributions made to the pension in that income band. So here's an example. We've got an individual, they earn 110,000. They've lost 5,000 of their personal allowance. That results in £2,000 more tax. By making a £10,000 gross pension contribution, adjusted income falls to below 100,000. Full annual allowance is restored, reducing the tax bill by 2,000, plus pension, plus normal, the 40% relief on contribution. That equates to a net contribution of £10,000, costing only £4,000. So for those people that are trying to get to that target of £370,000 in our example earlier, yeah, making pension contributions for their income above 100,000 is quite a good way of doing it. This just outlines some of the quirk, as I called it earlier. So we can see the tax rate up to 12,570 is zero. Then we're at 20% up to 50,270. Then we go up to 40%. Then to 100,000. That's when it jumps up to the 60% effective tax rate, which is the bit we want to avoid, really. So if we keep our income left of 100,000 on this chart, that's how we avoid it. So next section is taking the right amount of risk. We can obviously invest our retirement savings in a pension. Through that, you're generally taking on an amount of risk. So this will be taking place already through any employment-related schemes that you have. It will be invested in the stock market to a certain extent. And dependent on how much you have in the stock market compared to the bond markets, you can kind of get an idea of what your expected rate of return will be over a longer period of time. The thing with risk, obviously, it's correlated with your returns. In theory, the greater risk that you're taking on, you should be rewarded for that. But there are some things to consider around it as well. So there are three things or three considerations that we need to take into account when deciding what is the right amount of risk. So first is the risk required. So how much risk do we really need to meet our objectives? if you've already got a sizable pension, you know you don't need that much income. You don't really require to take on lots of risk to meet your objective. So that's what risk required is. And if say you've got relatively small pension savings at the moment, but you have a big need for income in the future, at this point you may need to take on more risk to get to that growth level, get to that capital value. Next is capacity for loss. So you might be willing to take on lots of risk, and you might need to take on lots of risk, but how much risk can you take on, or how much volatility can you bear without derailing your objectives? So it might be the case that you don't have the financial resilience to take on that level of risk. If, say, investments in an ISA drop to a certain level, that may impede on your lifestyle or your future objectives. So you need to judge your capacity for loss, or how much volatility can you bear with, and what level of permanent loss can you deal with without derailing those objectives. And then finally, but equally as important, is risk tolerance. So what level of volatility can you deal with and continue to sleep well at night? The thing with risk tolerance is really whatever keeps you in your seat and whatever allows you to stay the course is the best outcome, really. In an ideal world, we'd be taking risk, investing in the stock market, getting a great return because of it. But if dialing that risk level back allows you to stay invested, and benefit from the uplift in stock markets, then that's a beneficial thing. So before we look at returns, I want to kind of highlight the level of risk which is there in the markets. So we've got a table here, and the left-hand column, global equities, so the great companies of the world in the stock market. UK gilts, which are loans to the UK government, or fixed interest, otherwise known as bonds. Then we've got commercial property and cash. Next column to the right is maximum drawdowns. So from peak to trough, how much of those assets moved by? Global equities in the financial crisis dropped in excess of 55%. So that gives you an idea of how much things can move by. I mean, 10 to 15% movements in stock markets happen quite regularly. What's termed as a correction in the industry, and the recovery from those is relatively quick. Every so often you have these bigger events like the dot-com bubble, the financial crisis, COVID being one as well, which recovered quite quickly. But obviously you need to go into anything with investing with your eyes open that these things can happen. So UK gilts, I mean, 32% is still quite a big drop. Peak year was 2020, trough year was 2022. Liz Truss had a few things to do with this at the time. Still haven't fully recovered. The bond markets, yeah, it's the rate of return that you're going to expect from them is much less from the stock market, but you have much lower returns on them. Okay, and finally, UK commercial property. The UK commercial property is very similar drawdown to the stock market. Also exactly the same to UK gilts. We've seen a lot of ups and downs with commercial property, very dependent on what's going on with interest rates at the time. Then finally, cash. So with cash, there's been no drawdown. It's not gone down by anything on the face of it. But again, spending power is consistently being eroded by inflation, which is the sort of the sleeping giant there that's going to take chips away out of your retirement income. Okay, so this kind of illustrates the level of return that can be expected from investments, or that has taken place in the past. So we can see £1 invested in 1975 would be about £17.50 in today's terms. So quite a rate of return, really. Next asset below that, property. Then we've got gilts and cash. which over that time frame haven't really kept pace with inflation. So bonds do have a place in portfolio to give an amount of cushion if stock markets are falling. And sometimes, like at the moment, there can be opportunity in bond markets, but equities over the longer run is where you get your greater return. What this chart, or this quite dramatically sloping curve for equities, doesn't illustrate is the volatility that you receive in the interim. So that's why we want to make sure people have capacity for that volatility, so that if there are any drops in the stock market, there's a suitable emergency fund there to dip into. And especially for people in drawdown or taking from their pensions more flexibly, having a good cash buffer there, so in case they need to turn off the income from their pension, is paramount, because sometimes these lulls in the stock market can last for a couple of years. Most of the time they're quite sharp, but they're quite short, so things recover quite quickly. Okay, so our final section is selecting the appropriate withdrawal method and amount. So how can you take from your pensions? We've already discussed annuities, so that's where you exchange a lump sum for an income. That may be for a fixed term or for life. We've then got Flexi Access Drawdown, which you may have heard of, and a bit of the money for uncrystallised fund pensions lump sums. So the last two came around in the last, really the last 10 years, 2015 with pension freedoms. Capped drawdown was available previously, which was where you could take a flexible income from your pension, but that was it was capped at government set rates and amounts that you could have. Okay, so what is Flexi Access Drawdown? A retirement income option that was introduced in 2015 under pension freedoms. Lets you keep your pension invested and draw income as needed rather than buying a fixed annuity. So this can be quite attractive for people which are not looking to retire fully, or they look to retire fully now, would like to take a greater income up until their state pension commences, at which point they'll take a lower income. Flexi Access Drawdown allows you to do that because you're still invested. You also have the ability to get greater returns over a longer period. That may mean a legacy for your family. That may mean an additional amount should you need it a bit later on. So the key features are very similar to when you buy an annuity. You can take a 25% tax-free lump sum. The rest remains invested, giving potential for continued growth. Withdrawals are flexible, so you can take ad hoc lump sums, regular income, or a mix of the two. And you're not tied in to going down the drawdown route forever. In, say, 10 years' time, you wanted to go for an annuity, you can use your pension pot to do that. That's still allowed. So the benefits of flexibility, really. So you get to tailor your income to your spending needs. So you get to choose when you're taxed, and you get to choose when you take money to spend on various life events. There's growth potential, so the remaining pot stays invested, potentially beating inflation, depending on how you've invested. And you get to decide how and when you draw from it, adjusting for lifestyle changes. There are risks attached to drawdown, though. So the biggest risk is that you run out of money, which is something that we're obviously trying to avoid through this session today. So you're exposed to investment risk. The pot can fall in value. There's no guaranteed income like you'll get from an annuity, like you get from state and defined benefit pensions. You might live longer than you've expected. So you run the risk of running out of money if withdrawals are too high or if markets outperform. There's more of an administrative burden as well, because if you buy an annuity, that's it, done and dusted. Quite clean and simple. You know what you're getting, or by how much the money will be going up by each year if you get an escalating annuity. But with drawdown, your money remains invested, so the need for ongoing review and advice to stay on track is still there. There is also the risk of or the impact on future contributions. So as soon as you take taxable money from a pension through drawdown, the money purchase annual allowance kicks in. So that reduces the amount you can add to a pension down to £10,000. So quite a drop in comparison to the 60,000 annual allowance. So who does this work best for? So those who have, say, a state pension, defined benefit or final salary pension coming in, if they've got a private pension, drawdown may be a good way to top up things as and when they need some additional money. So those with the willingness and ability to take investment risk, it's also appropriate for them. And people that need flexibility or desire to leave a pension or wealth to family, it can also be suitable for them. What I find with a lot of clients is we tend to get some income sorted through annuities, so set up an income floor, so that's state pension, final salary annuities. A lot of the time, the state pension, well, all of the time, pretty much, state pension will fall away on the death of one of the spouses, and then a drawdown pension can then drop in to fulfill that gap later on down the line. Shouldn't be too much longer now, but we're on to uncrystallised funds pension lump sums, or UFP+, as the acronym. So what this allows for is taking lump sums from your pension. 25% is tax-free. Remaining 75 is taxable at the marginal rate. Can be a bit more straightforward because you're taking just a lump sum. There's no need to set up a drawdown, although the rest of the pension will remain invested. As with drawdown, it does trigger the money purchase annual allowance, so your contribution levels are restricted down to £10,000 once you do it. What some pension providers will allow you to do is set up regular UFP+ payments. So if you were, say, I've got an example which we can go through now actually. So if we were, say, taking £1,000 a month out, to get to that £1,000, you would have paid in £800 net. Tax relief added takes you to £1,000. When you come to withdraw it, 25% is tax-free, so no tax on £250. 75% is taxable, so that turns into £600 net. Adding back your £250, which was tax-free, you get a net figure of £850 when you've paid in 800, and that's pure tax gain. There's no investment risk with that. So with some providers allowing you to set that to happen on a regular basis, it can be quite good. So taking some tax-free cash, some taxable income in one go can be quite a tax efficient way of doing it. So just going to nip back to obviously some risk considerations. So large withdrawals it can push income tax into the higher rates. Once the money is spent with drawdown, it's gone. Again, with the money purchase annual allowance, you're going to get restricted down to what you can put in a pension. So worth considering those from normal pension age for personal pensions and state pension age and still working. And again, the investment risk remains on you as the pension holder, nobody else. It's all down to how your pension performs. Okay, so looking at withdrawal methods now, how do we figure out how much you can withdraw? So when we do this for clients, what we tend to create is a cash flow forecast that will look at their expected outgoings over the rest of their life, including lump sums for big events in life. And then we make a tailored withdrawal strategy from various assets, which will obviously include pensions, ISAs, there may be a sale of a property or business. So all of those things go into the mix. But if you were to sit there and do it yourself, the 4% rule is one which is quite well publicised and discussed. So how does this rule work? So spend 4% of your pension in year one, then rise with inflation each year. So studies have taken place in the US over a 30-year retirement and a balanced portfolio. So that's 60% equity, 40% bonds or fixed interest. And with that study, it's shown that people haven't run out of money over a 30-year retirement. The thing being, though, is we've got different market returns in the UK and inflation patterns than the US. One thing that we tend to have in the UK is home bias, which is basically means you invest more in your local investment market than the US. Historically, the US has done a lot better, so it may not fit for a do-it-yourself UK investor. Longevity, so many live well beyond 30 years now. So you may get up to a desired amount, stop working, kick off your 4% rule, take your money, increase it with inflation, and then find you run out of money in later years where you don't have the human capital for you to be able to go out and still work and earn an income. So it can be quite dangerous. It also doesn't flex in times of poor markets. So that can again run the risk of running out of money. So say if you've got a drawdown pension, you're happily taking your 4% a year, it then halves in value. You're going to be taking out a lot more than 4% a year then it will limit the life of that pension. That's why we look to go for a slightly more nuanced approach, keep cash aside, just so we can dip into that money if necessary. So there are other more robust strategies if you were looking to do it yourself. So guardrails. So what that is, you basically set a withdrawal rate at outset, dependent on how the portfolio fluctuates. So it's, in my example a moment ago, the portfolio halves, you have to drop your income. If it goes up, you can give yourself a pay rise, but you'd be more flexible with it. It's also floor and upside, which is you've got your income floor, which covers your essential expenditures, and then invest the rest through drawdown, something like that. And then more dynamic rules, so adjusting spending with portfolio health, which is quite similar to the guardrails method, really. So hopefully that gives you a bit of an idea of how you could potentially do it yourself. As I said, we take a slightly more nuanced approach, review annually, use cash flow modeling just to stress test. If we did see a market drop, would income still be okay at the rate it's being taken? Do we have enough cash to cover those periods where income may need to be turned off in drawdown? Okay, so last couple of slides. So a recap for you. So understanding the challenge was getting to grips with how much money you need and start preparing early. So size up the challenge, then you can get a plan in place to get there. Optimizing the guaranteed sources of income, so making sure if you've got gaps in your national insurance contributions, you buy some of those years back to get a full state pension if available. Using final salary pensions, annuities and other state benefits to create an income floor to cover your essential expenditures. In your working life, you want to maximize the freebies. Obviously, very few of them, so grab them while you can. That was obviously auto-enrollment. If you don't contribute to your auto-enrollment pension, your employer won't, so you're missing out on free money. That's obviously claiming back or getting around the 60% tax trap for those high earners, so really worthwhile doing. And asking whether your employer will offer their savings on national insurance. Taking the right amount of risk. Volatility can be scary at times, but in the long run, it tends to be your friend, especially for those in the early stages of saving for retirement. Might sound a strange way of thinking about things, but if the market drops, that's a really good time to potentially increase your pension contributions because you're buying everything when it's cheap. It's a bit like walking into the supermarket, and any clients watching this, apologies, you've probably heard this already, but walking into the supermarket and everything's on sale, you're probably going to put a few bits in the freezer. Then selecting an appropriate withdrawal method, ensuring care is taken. Even with annuities, care needs to be taken because once you've done it, you've done it. More so with drawdown, if you only go that route, you could run out of money. So there are risks attached to that. This would usually be your opportunity to ask some questions and I'd answer them, but we'll skip on because no Q&A today. But if you do have any questions, please feel free to scan that QR code. My contact details are there, so feel free to reach out if you have got any questions. But yeah, thanks again for watching. If you made it to the end, well done. And for those who attended the webinar, my apologies again. Hopefully this has been good for you. All right, thanks very much. Bye.